going on, everybody? Good morning and welcome back to Beat the Bell. Hope you guys all had an awesome weekend. Should be a pretty interesting week in the markets. Lots to talk about this morning. We, of course, have all been watching the news over the weekend that we'll talk about in a bit. But the market is already moving early and could be a crazy one. Money Mander, good morning.
Good morning. Happy Monday. Fresh week. Lots of interesting developments over the weekend that we'll touch on in Fed forecast.
All right. Diamond Trades. Good morning.
Good morning. Good morning. Happy Monday. Let's get into it.
Jesus Christ. You know, after our conversation, I think it was on Saturday, I looked up the whole Rihanna Drake.
Did you?
The 2016 MTV Music Awards. That was a bad look for him, man.
Yo, crazy move by her. Like, to be completely honest, like the disrespect, absurd.
Yeah.
We'll let it slide. All
right, Stock Sniper, good morning.
Good morning.
All right, let's get into Fed forecast and economic calendar.
Yeah, let's kick it off with the economic calendar for this week. We've got really nothing today. Today is technically a bank holiday, Columbus Day. The markets are obviously going to be open, but just keep that in mind today. If we get a little bit of lighter trading volume, price action may not be optimal. Tomorrow, more Fed speakers, no news necessarily, but 7 Fed speakers to start the week. So expect them to be pushing the market around. And then the high impact news will pick up towards the middle of the week with PPI and core PPI Wednesday morning before market open, as well as the FOMC minutes release on Wednesday afternoon. Thursday, we've got CPI and core CPI. And then on Friday, we've got Michigan consumer sentiment. These will be the last inflation readings, if I'm not mistaken, before the FOMC meeting. Do they meet in October, Sal? They meet next week, right? If I'm not mistaken. We'll double check on that. But I'm pretty sure that this
November, I believe. No October meeting.
Okay, got it. So we will get another batch of inflation data before their meeting. But nonetheless, this inflation reading will be important. And then as far as earnings go, Q3 earnings are going to start this week with Citi, Wells Fargo, JP Morgan, and BlackRock all reporting Friday before the open. Within the next 30 days, we'll get reports from Apple, Meta, Tesla, and other tech heavyweights as they show investors how they're faring into the holiday season. Speaking of earnings and earnings optimism, as we head into earnings season, investors are paying close attention to the extent to which tighter financial conditions based on where yields are currently trading have impacted corporate profits and strategy heading into the end of the year. The S&P 500 is down 6.1% since the end of July, cutting its year-to-date advance to 12%. The pullback has wiped out most of the blue chip Dow Jones Industrial Averages 2023 gains. The deterioration of corporate profits was expected to have hit its trough in Q2. Q3 earnings for the S&P 500 companies are anticipated to have fallen 0.3% from a year earlier versus a minus 4.7% in Q2 and minus 1.96% in Q1 of this year. So given the news last week that the U.S. economy added the most jobs since January, reconfirmed the notion that the American economy remains strong, at least the jobs market remains strong, thus reinforcing the implication, obviously, that the Fed officials will opt to leave rates elevated for longer than previously anticipated in an effort to cool the economy. This earnings season will be particularly important as analysts are looking for the communication services sector to be the shining star of the 11 S&P sectors led by Meta, and are expecting the largest earnings declines of this season to be in the energy sector, given where oil prices were last year. Lastly, investors will be paying close attention to how the strength of the dollar has impacted corporations that do a lot of business overseas, as a strong dollar can make products less affordable for international consumers. A key factor heading into this earnings season is that many stocks have pulled back from their year-to-date highs, and thus may have some more upside surprise potential versus last earnings season, where a lot of stocks were quote unquote price for perfection, trading near year-to-date highs. And we really didn't see the market rewarding those positive earnings to the upside as much as we saw the market punishing disappointing results to the downside. So we'll have to see if that trend is going to change going into this earnings season based where companies are trading at and have traded over the past several months. Mander, what do you got?
Yeah, well, for what it's worth, the next FOMC meeting is November 1st, so this will be the last inflation data that we get before they meet again. What I wanted to cover today is as if the markets needed any other headwinds. Obviously, I'm sure everyone's been wrapped up in the ongoing situation over in Israel, and so politics aside, that's not really our place to dabble our foot, but we can take a look at how it's probably going to affect the markets and in what sector. So, firstly, hopefully, everyone put up their gas tanks last week on the dip in energy prices. Crude oil futures set to open the session day up 3.5%. Amid fears of fallout in the Middle East leading to production and distribution issues, lowering global supply. And so crude oil leading the move to the upside. Obviously, you'll see the relative strength in the S&P versus tech so far today in the pre-market trading. Energy stocks and obviously the defensive names in Lockheed Martin and other war names, war trades probably attracting bids today. So all major index futures down this morning around 0.5 percentage point. VIX and dollar both up. Here's what I'm going to be watching. I think will be interesting moving into tomorrow's session. So whether we get some type of knee-jerk reaction to the downside or the upside today, obviously everyone remembers back in the Russia-Ukraine invasion, massive bid to the upside off the gap down. So potential for that to possibly happen again today. But with it being Columbus Day, the banks are closed, and as such, there is no bond trading today. So I looked across the pond to see what was happening in other international markets. The Israeli shekel and the Israeli bonds are both obviously selling off amid fear, but it actually is looking like rotation into other safer assets with the German and the UK's 10-year yields dropping significantly as investors are putting money into those safe assets. So as we move into tomorrow, what I'm really watching when the bond markets reopen, should we get the case where a lot of international money is flowing into safer assets outside of Israel and we start to see a meaningful bid come into domestic U.S. bonds? I think if we start to see a meaningful dip in the 10-year domestically, we saw a shooting star on Friday after it opened up into new highs after the NFP report, new highs in the 10-year into a shooting star, obviously could not maintain that higher level and actually closed below the previous highs on the 10-year. So if we start to see a meaningful pullback here in the 10-year, I think this could present a situation where you get a buy the dip early in the week here off the gap down amid the war fears, actually leading into a decent spring into the rest of the week. If we start to see the dollar and the 10-year yield start to pull back amid rotation from international investment. So that's one thing I'm really watching this week. Obviously, geopolitically, it's not great. Does it truly affect the U.S. economy that much? Maybe not. And so I think if we start to see yields pull back and the dollar pull back, we could definitely see some meaningful upside here in stocks. So gapping down this morning, we'll see what we get into the rest of the week. But that is really what I'm watching going into today and the rest of the week session.
I think it kind of makes sense technically too when you look at sort of how we traded into the end of last week, right? We were able to hold support on all three indices, looking like that sort of double bottom look in the NASDAQ, and you're getting like a false breakdown look on the daily chart in the S&P futures. So, I mean, from a technical basis, it does make sense. And I think that would be a nice opportunity, particularly just with the amount of sort of weakness that we've seen over the past several weeks. We may get a little bit of upside here, sort of like a mean reversion move before, I guess for bulls, we'll really hope that this October low seasonally, tends to sort of push stocks into the end of the year. I guess that's what bulls will be looking for. And bears will be looking hopefully to flip previous support into resistance as we come up and retest some of those levels that we haven't traded at since the summer. But that'll wrap it up for us here. Fed forecast, pass it back to Alejandro.
Noah, you mentioned it. We're coming into that point in the year when typically we do see that seasonal bottom, and it looked on Friday like we were really close, or we may have gotten it. The reason being we got that false breakdown, as you mentioned, in the S&P futures. We also got the buy signal on the system with the bullish cross of the 10 SMA over the 50 SMA. But of course, over the weekend, the headlines have added some volatility to the market. So looking at the chart and how things closed on Friday, it was pretty clear that bulls are in control, trading above the 50 SMA on both the charts here. And that's what bulls are going to want to hold in today's session. Maybe we get a dip below it at the open and then a recovery, which would be bullish. As long as Friday's low continues to hold, that is the false breakdown that we put in. This is going to continue to be a bullish looking market because that is a bottoming pattern. And as we've been talking about, we've been looking for that October low to be put in. But that being said, it's really important to remember when we do have that headline risk that technical analysis, make sure you're taking it with a grain of salt. I would advise to just be careful with trading. Understand that when there is headline risk, you can be in a position it could quickly reverse against you. Hopefully those of you who have been trading for a little while know exactly what I'm talking about. But right now is likely going to be difficult times to trade. And the dangerous part is that it seems like there's a lot of opportunity, right? When the market is moving around, that's when traders get really excited that they can make a whole bunch of money. But realistically, there's just a lot of risk being added right now. So I know personally, I will be trading size down if I do decide to do any trading. But from a technical perspective, using the system, bulls are going to want to continue to trade above the 50th SMA on both the charts. Let's go over to Stock Snipa now for Bet the Bell.
What's up, guys? I got some stuff we don't normally talk about that we're going to talk about today. But let's start off by taking a look at our standings and seeing where everybody is at. We can notice that we don't see it here, but actually Diamond and Alejandro are really close. But I'm going to transition over towards our next question, or our first question, which is green or red today. I'm going to go ahead and start this one off with Diamond trades.
I'm going to go red today. I mean, indices gap down like 0.5% each. Bank holiday as well, like I talked about before, so I'm not really expecting like a ton of volatility to really push us up and fill the gap and close green. So I'm going to go red today.
I like it. Money Mander, what do you got?
So Mander with the sole win on Friday. I'm going to take the exact same position here and just go green for the sake of. I'm hoping we're seeing a pullback here in the pre-market base and then set new highs over last week's high on the continued bid.
Money Mander picked green last week when everybody picked red. For those who might not have seen it, we are arranging a parade, and an airplane should be putting a sign up for him. Alejandro, what do you got? Green or red?
I am going to go with red.
I like it, and I'm going to have to take red too. Looks like Money Mander is the only green person again.
We can't all go red, so I'm glad I took it.
Interesting. I like it, though. So my next question for you guys, which is a pretty interesting one that we don't see typically, is what is your favorite dividend stock? Now, I want some good answers here. There's many stocks that we can. For those of you who are not aware of what a dividend could be, it is a portion of the profits that companies give to shareholders every 3 months, and it is given based off of the shares. So the more shares you have, the higher dividend you would have. Dividend is for each individualized share. But I'm going to go ahead and start this off with Money Mander.
So this is a tough one because dividend stocks have been getting absolutely destroyed in this hiking cycle. I think if I'm going to take one, I'm going to take AT&T, which is a hard one to take because it's trading at like 15, 20-year lows. Stock's been getting destroyed. However, you have to look at it. If you were to reinvest your dividends, I believe the dividend sits around 8% on this one. If you reinvest the dividends, you're still up a good 500% plus if you were DCAing with reinvested dividends over the past 20 years, even though the stock is trading at pretty much lows. And so even though the stock's beaten down, it's a cash cow. It's one of the biggest mobile providers, cellular providers in the entire world. I'm going to take AT&T here, especially for the 8% dividend.
7.68% dividend right now with the current share value. But, yeah, really a good number right there. Diamond Trades, what do you got?
I think I'm going to go with a financial here. And I think I'm going to take – because that's the thing, right, is like it's tough to want to take the financials because, like Mander said, dividend stocks have been getting killed because of where yields are. But, like, theoretically, higher yields should, like, help out the bank. So it's like if the yields come back down, like, that's not necessarily like a positive tailwind for banks. I'm still going to go with the bank, though. Because even like with Mander's pick, like AT&T, like that's really like a pure dividend play where like you're not really playing for like share appreciation. Whereas like I think that you can take a JP Morgan and sort of expect some sort of share appreciation, even like given where yields are. So I'm going to go with JP Morgan. Where's their yield at right now? Does anybody know?
Dividend, we can find out quickly.
Yeah, I'm gonna take JP Morgan. I don't even care where the yield is.
The answer is 2.89%.
I'll take that. I'll take that because I think that you also, like I said, you can also get the share appreciation there. So yeah, as opposed to like one of the communications, which are effectively like utilities at this point, Verizon, AT&T. Like you're not really getting share appreciation there.
Well, you
So-
can look at Apple with 0.54% right now,
Yeah.
and that is 4x Apple basically.
Yeah, but like I don't care what Apple's dividend is when I buy Apple. Like I'm not buying it for the dividend. So
Yeah, but that's one of the most common dividends that people receive.
nice.
That can't even qualify as a dividend stock.
I mean, I'm just putting it out there. I mean, more people own Apple than anything else.
I got you. I'm still gonna go JP Morgan. I'll go JP Morgan.
All right. Alejandro, what do you got?
All right, so I've got XOM, 3.4% dividend yield. The stock is trading nicely in the pre-market. As these new headlines start to swirl around, we could see energy and oil prices rise. And the stock is also coming off a pretty bad month where it was down about 4 or 5%. I think that to use Diamond Trades' terms, we can see some share appreciation into the later half or into the rest of the year here. But also, of course, the stock is a dividend aristocrat, and that 3.4% is beautiful.
I like it. That's pretty nice dividend right there, especially on energy. And energy stocks are awesome to own.
I was gonna go Exxon Hondo, but I don't know. I just feel like with
You didn't, brother.
No, I didn't. I intentionally didn't because I feel like where oil is, like I feel like we're not just gonna sit up here forever. Like oil prices have to come down at some point. And you also didn't give us a time frame, Snipes. So
Famous last words.
I was thinking like, yeah, it's true. I was thinking like long term.
I was thinking like a year. Typically, the question is a year.
Then yeah, maybe I would have went Exxon. But yeah, I like that pick. It's a good pick.
I'm gonna have to go with Ford. With Ford right now, we're looking at a 5% annual dividend yield. Shares are $12. Quarterly dividends are sitting at 15 cents. Looks really nice on the dividend side there.
Buy and bottom.
Control.
Buy and bottom on the auto worker strike.
Yeah, we got Meatball in the comments. Goldman Sachs 12.9%. That's kind of nuts. But yeah, that'll wrap it up for this question. Definitely some interesting questions or answers we had here. But my next question for you guys, which is going to be pretty interesting also, is which sector do you think is the worst sector to invest in right now?
Take someone. I want to hear some other takes first. This is a tough one.
I'll go, I guess. This is a tough one. I guess I would go with I almost want to say consumer staples. I almost want to say consumer staples. I saw a really cool graphic. I wish I had seen this question earlier. I saw a really cool graphic the other day of consumer spending in aggregate over the last I don't know 5 or so years and how it kind of peaked mid last year. For that reason I want to say consumer staples, but at the same time if the global and American economy do eventually slow down like people are predicting in the next call it year, I feel like those would be sort of safe haven ish trades. And then especially I am going to take consumer staples, because when you look at it for the long term, one of the problems that's actually that consumer staples are facing right now is you have a shift in people's spending from for example, a good example is Kylie Cosmetics. You have influencers who are able to create centers of influence where they can sort of push out their product, and I think that it's going to be very hard for the traditional consumer staples companies to compete. You look at Mr. Beast, what he's doing with his fast food thing. So it's I feel like you're going to see a lot more of that sort of influencers creating their own personal brands. And I think that's not something that's easily I don't think that's something that consumer staples companies, the traditional way, they've just gone to thrown more money into advertising. And I feel like that's not going to be it. They don't really have the competitive edge on advertising anymore going forward with the amount of influence that some of these people on social media have. And so I feel like that is going to, and again, it's not like they're going to like roll over and die. Obviously, they're going to figure out, they're going to try and figure out a way to compete on that front. But I think that's a problem that's really facing them going forward over like the long term. I'm talking like next 5-10 years. I think that's a problem they're going to run into. So yeah, I'll go consumer staples for that reason.
I like it. What do you got for me, Money Mander?
Yeah, we can come back to me now. That was a really good answer. That was between that and a few others. I think I'm going to take financials right now. And while it sounds a little rogue, I'm looking a little bit down the road here. If we're looking on a 1-year investment horizon, a lot of really negative headwinds coming in. While they're already trading down thanks to the rising yields, I think if you start to look out into next year with the BTFD payments being due in March, still a lot of unrealized hold to maturity losses on their bond portfolios. And really where the Fed's pinning rates, or if they're saying they're going to cut maybe 2 times into the end of 2024, I think these are going to continue to be problems, at least for the next calendar year. So I'm going to hold off on financials. I think that is where I wouldn't park my money quite yet.
I'm going to have to take utilities, not because I think that they are risky or because they're too volatile, but I think based off of where they are sitting in the market, they have the most room to fall. I think that there's definitely more room there than most of the other sectors coming towards the downside.
Utilities got smoked last 2 weeks.
Before
2
that,
weeks ago, they were down 7%. Last week, they were down almost 3%. They've been getting absolutely slaughtered this last 2 weeks.
I think they still have plenty more room to fall. But that'll wrap it up for Bet the Bell today. I'm going to pass it back to Hondo here.
All right, guys, that's going to do it for this morning's show. Appreciate everybody who tuned in. Once again, hope you guys all had an awesome weekend. Can't believe that the Phillies beat the Braves. Makes me want to fucking vomit everywhere, even though I hate both teams. That's playoff baseball. I mean, the Orioles are down 2 games. The Rangers are just playing out of their minds. The Braves hadn't been shut out at home all year long. And then Philly trots in there and
teams get hot. Anything can happen. It's fun to watch.
Anything can happen. All right, guys. That's going to do it for this morning's show. We'll be trading live all day in the King Capital Discord. You guys can go to king-capital.com or scan the QR code. It's about to pop up on the screen. Other than that, we'll see you guys back here on Wednesday morning at 8:30 a.m. Eastern Time. Have a great rest of your day, everybody.